Welcome back. We're counting down to the pre-opening rates. For now, I think there's a minute left to go. The SGX Nifty is suggesting a start in the green. Dipan Mehta is still with us. Dipan, we're heading into a conversation with one of the diagnostic companies very soon. And here there's rising competition, right? I mean, now Torrent is planning to enter into this diagnostic space as well. We have a long list of new entrants. There are price cuts that are underway too. These are stocks that have already fallen about 30-40% this year. Do you see more cuts here?
So that's a difficult one to answer because clearly there's disruption within the sector and they had this opportunity when COVID was there. But now I think it's business as usual. And some of the players coming in are deep pockets, very strong players who understand the market as well. So when there is so much of disruption and uncertainty, I think it's best to just stay away. Just because stocks are corrected 30-40% doesn't mean that they cannot fall further from these levels. And I think the most important aspect here is it's not that these stocks are really cheap at around 20 times PEGs of 1 or 2 times or so. They are still quite expensive at this point of time. So I'd like to avoid all the diagnostic companies, and the best way to play healthcare would be to the hospital companies. I think apart from Apollo, I think all the other hospital companies came out with a very good set of numbers. And there's good scaling up opportunity within the sector as well.
Dipan, any thoughts on names like V-Mart, which operates in the retail space, but in tier 2, tier 3 cities, right? So the stock did very well, has corrected a little bit. Increasingly, though, we are hearing from various quarters, various companies in various sectors that the lower end of the price curve is hurting, demand is hurting. We are hearing from white goods makers, all kinds of companies. So, any thoughts on this one? Yes, sorry.
That's right, Prashant. And even on the rural consumption side, I think things have yet to pick up. The rural consumer is still struggling with the damage caused by COVID per se. And that's, I think, where the pain point is there for V-Mart. And last quarter results were a bit disappointing, but corrective action is being taken by the management. See, the long-term trajectory of something like a V-Mart is exceptionally good. It's an aggressive company, very well managed. The promoters understand the customer, the trends over there, and they are playing in that tier 2, tier 3 market where they are winners over there. And the acquisition of Unlimited was a good fit for the company, provided them geographical expansion as well. So, I mean, I would say that if you already invest in the stock as we are, we continue to remain invested, hold on to the stock. I think it's a great long-term story. But I think in the next couple of quarters could be a bit challenging for the company, and you could see sideways movement to marginal declines as well. So from that point of view, I wouldn't want to advocate fresh purchases, but I think existing investors can remain invested as we are.
All right, Dipan, it's a pleasure as always. Thank you very much for joining us here on the program. Thank you very much for your time on CNBC-TV18. Just the pre-open session is coming up. We should just take quick note of that, and then we'll move on. So the rupee is also started trading. The rupee at about 79.8 as compared to 79.84 yesterday, and the Nifty is starting about 14 points higher. So it'll settle down. I mean, SGX was indicating a lower start yesterday. We started higher and then never looked back. I mean, the 100 points came very fast, and then there was no give back at all. So will we get a repeat? Or will some of the global markets, which continue to remain on back foot, start to weigh in? So we'll see. Now, one company which is in focus, I mean, I don't want to say for the wrong reasons, but at least, I mean, it's an, the sell side or analysts who track that space are not very positive, is the diagnostic space. So we had Antique yesterday, and Nimesh highlighted this quite a bit, which Antique, the broking company, put out a report titled Diagnostic Sector Spiraling Downwards. Let's ask if there is really a spiral downwards or not with one of the leaders of the sector. Dr. Lal PathLabs is the company I'm talking about. The reasons, of course, why analysts are a little cautious is well known, increasing competition primarily. Let's have, Mr. Om Manchanda of Lal PathLabs join us now to answer those questions. Mr. Manchanda, great to have you with us here. Thank you very much. Are analysts making too much of what's actually going on? Or do you think structurally there is a problem now in terms of prices that you'll be able to charge, volume growth also getting very dispersed because there'll be so many new competitors? Tell us, sir.
Good morning. So I think what's probably happening in FY23 is that entire industry is fighting the decline of COVID compared to last year. So I think a lot of sales comparison is happening because starting this financial year, COVID sales are badly down nearly about 80-90%. I think the first task for the industry is really to offset those losses with non-COVID. But probably I'll shift the focus on medium to long term. India is highly sort of under-penetrated as far as diagnostics is concerned. The first wave that we had seen was shift of unorganized to organized space in diagnostic was mainly in metros and maybe tier one town. I think I'm seeing a structural shift coming in due to higher competition in tier two, tier three. So probably my sense is we will see much more organized competition that we have seen in the past. So I think that's the way future looks like. And I think the comment about the rising competitive intensity and price war happening, at some level, I do believe that this will definitely aid the growth of the market, especially in the area of wellness or screening. And in my view, there is this competition really is not disrupting the cost structure. It's mainly disrupting the prices. So that means some of these price points may not really be sustainable. But I think one should look at a medium to long-term growth in this industry. This short-term quarterly variations are mainly happening due to COVID decline, per se.
Oh, no, that point is taken. Om, hi, good morning. The point Antique is making, especially in the Western market, I mean, if you look at suburban's contribution, non-COVID perhaps is not growing as much as you would have liked. If you could, I can understand one or two quarter, here or there, but in general, are you still confident on, the suburban bet that you have taken and whether it will contribute in a meaningful way?
Yeah, going by our experience in Delhi markets with Dr. Lal Path Labs, I'm fairly confident, and I think probably these things one should look at in much longer term. It's just been a couple of quarters the Suburban has been with us. We have to put together a few systems and processes, and I think it's going to take 2 to 3 years before we start seeing the results. And just remember that frequency of purchase in healthcare is not that frequent. It's just that sometimes patients actually come to you after 6 months or 1 year. So I think it's going to take time before we start seeing results. But I'm pretty confident that Suburban is a great platform for us in West Market and highly concentrated in one city. And we are probably building up a foundation for our future growth, especially with the launch of high-end reference lab. And any lab that we put up in Mumbai also would serve southern markets as well. So it's a pretty long-term play for us. We are not looking at Suburban from a short-term perspective.
Okay, so you're not looking at Suburban from a short-term perspective, but the problem, I think, is, Suburban in any case is tracking with lower margins now. I mean, the margins had fallen to 15% versus 20% plus last year. And then you have rising competition. So are we looking at a case of more margin pressure, at least over the next 1 to 2 years, given the situation? And if yes, on an average, what could it be for Suburban?
Yeah, Suburban, I think we knew very well that it's going to dilute our margins because Suburban pre-COVID margins are much lower than our overall portfolio margin for the parent company. It's just that we were expecting decline in COVID, but we didn't expect that it's going to be very, very sharp decline in a very short period of time. And that has happened for the entire industry, not only for just Suburban. And Suburban, actually, contribution of COVID was very high, so the impact is also equally high. But our focus essentially would remain on non-COVID business. I think one learning that we have had from COVID in Suburban is that if the top line grows faster, you are able to see operating leverage flowing in. And I think that's clearly visible. And that's what we had seen in Dr. Lal Path Labs as well. So, I think Suburban is definitely diluting margins as far as Western market is concerned and overall parent company is concerned.
So
coming to your point about competition, I have always said before also that at this point in time, we don't want to really change the price points, and we believe that this market is not highly price elastic, and people are discerning enough as far as the quality is concerned, as far as service is concerned. And I think most important point to note is that we have to look at our cost line. Is there something wrong with that? And I'm not seeing that sort of a cost disruption which competition is having. They're just dropping the price and maybe adopting a cash burn model, which to some extent, in my view, will not be sustainable.
That's an interesting way you put it. It's not changing the cost structure. It's impacting the pricing, though. So then it's not sustainable. The pricing will maybe drift up.
Yeah, some of these companies are unlisted companies, so the numbers are not visible to me. So I presume it will be difficult for them to sustain.
You know, the Antique also says that margins that you saw during FY21, right, will not be repeatable anytime soon. Revenue growth also from being 15% plus over the last couple of years should come down to about between 10 and 12%. Are those the numbers one should work with? This is a slightly longer run question.
Yeah. I think FY21 and 22, both these years had advantage of higher operating leverage flowing due to higher COVID figures.
Yes.
So I think that point is correct, that margins in these 2 years have been higher, not only for us, but for the entire industry. So industry won't be able to repeat these margins in the coming years. So I think there are 2-3 things we need to achieve. One is to go back to pre-COVID levels for non-COVID business. Not only in absolute terms, but from growth perspective. And it will be unfair this year for comparison on year-on-year basis, because last year base month-on-month variation is very high. There are some months where non-COVID numbers are very soft, some months where non-COVID numbers are very high. So in my view, everyone should look at a quarterly trajectory, how the trends are moving in terms of whether we are building up quarter on quarter. I think from April onwards, we are seeing very stable quarters. The next two quarters are very, very important for us to see the trend. As far as margins are concerned, I think most important is to go back to pre-COVID levels rather than what we have seen in FY21-22. I think last 2 years, margins were unusually high due to
Got
COVID.
it. All right, Om, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. That's Dr. Lal. The stock, of course, has seen a bit of a knock of late. The pre-open has settled the Nifty higher by about 30 points, the Bank Nifty higher by 87. The real gains have been in the mid-cap space. The mid-cap index opening firm, advanced decline looking good. Sudarshan, if we open here, do you buy immediately or wait for a dip? The dip didn't come yesterday intraday. You had to buy at the open itself. And what's the 9-10 call?
That depends on the trader. I usually wait for 15 minutes and then buy, whether there's a dip or no dip. But it depends on what the trader wants to do. The trade is to be on the long side of the market today. And Dixon is also a buy with a stop under 4110.
Okay, Dixon Tech did well yesterday as well, up about 1% in pre-open. Mitesh, what are you going with for 9-10?
I will choose a buy on JSW Steel with a stop at 668 for targets of 710.
Okay, all right. Well, that's on JSW Steel. By the way, in pre-opening, a couple of stocks do deserve mention. I wanted to talk a little bit about the tire space because Morgan Stanley has come up with a very interesting report on the tire stocks. They're positive on the market as a whole, and they say that the volume will be stable. But there are 2 stocks that they're looking at. Apollo Tyres, they've initiated coverage with an overweight rating, and they have a target price of 329, which is a big upside to the current market price. They say that they expect a 30% upside to the current market price. That's because the India business of Apollo Tyres is all set for the turnaround. Remember, Apollo Tyres is the second largest player in the Indian passenger vehicle tire space, and that has been growing at a very fast pace. The focus also for Apollo Tyres is on controlling costs and expanding margins, and that will help them in their performance. Now, the other stock that they're looking at is Balkrishna Industries. Over there, they are underweight. They have a price target of 1649, which is well below the current market price, and they expect a 17% downside to the CMP. Now, they say that, and we had featured this earlier, that there's a big demand slowdown underway in the agri market in Europe, and Balkrishna Industries has a presence there. So because of that, the stock could continue to be under pressure as it has been over the last many days.
Sonia, thanks for that. We'll track these 2 names as markets open. Now, Syngene is also in focus. Nimesh is standing by to tell us why. Nimesh, hi.
Hi, Prashant. So there's going to be a large block in Syngene today morning. So Biocon is looking to sell up to 5% stake in Syngene via block deal. The book was launched last night. The indicative price is around 5% discount from yesterday's closing price. So the base price is 550 up to 573. So in between that, the block will be done. In terms of demand, I believe a mix of domestic as well as some big global funds are likely to participate in today's block deal. So a big block to start with. Syngene will open in the red because there is a large block and a bit of a discount. But maybe it will recover intraday post the block is done. Also, there is a 90-day lockup now for Biocon to sell further stake. Remember, Biocon owns close to 70%, and the initial feedback was that they were looking to sell 10% stake. But this is only half block that they're doing. So maybe even if they want to sell further, it will be a post 90 days only. And as I said, there is a good mix of demand from both domestic and global investors. So watch out for Syngene in the start. May open red, but may recover as well, given that, the stock ended 3% lower yesterday, and there was an anticipation of a block coming. So bit of short as well on the stock. So maybe you'll see a bit of covering as well after the block is done.
Nimesh, interesting. You said Biocon initially was looking at selling 10%. So why are they doing 5% now? Any feedback?
Well, Anuj, if you remember, I had alerted this way back in July 22nd that, there is going to be a large block, and had indicated that one of the strategic investors will sell. I believe, even the delay in the book, the stake sale seems like there is not enough demand and appetite for the entire 10% block. So maybe that's why they're selling only 5%. Not sure. This is all, here's your feedback that I've heard from dealers and investors.
Got it.
But to start with, there is only a 5% block and a 90-day lockup. So nothing further can come for at least next 3 months.
All right, Nimesh, thanks a lot for that update. Yes, you alerted us about this block. The first rates are in on the Nifty, and once again, look at that, 45 points, 50 points higher on the Nifty now. The SGX can indicate whatever it wants to. The market is in a completely different mood right now. 56 higher now, 17,724 on the Nifty, 60 points higher now. The Bank Nifty is up 180 points. Off to the races, you'll have to say that. That kind of a market, and just look at the broader market. The mid-cap index is up about 176 points. I think maybe today you just want to look at things and say, okay, is this getting a bit overdone in the near term? But the market is supreme, so just moving on. In terms of individual names, you have NTPC, which is leading the move, 1% higher on that. Tata Motors is up about 1% as well. Britannia, Coal India, Tata Consumer, UPL, Power Grid. These are a few names doing well. HDFC Life as well, Britannia. So looking good over there. Apollo Hospitals as well is higher. Bajaj Auto is up about 0.5%. The Nifty is not stopping at all. It's so much of a deja vu like yesterday. Yesterday also the SGX Nifty was indicating a flat start. The market just made a mincemeat of that and just moved on. 100 points higher now on the Nifty. Reliance is contributing now, and how? About 1% higher on Reliance, ICICI Bank, Bajaj Finance, Axis. All these stocks doing well. No point talking about losers because there aren't many. The Nifty up about 0.5%, 83 points higher, and the juggernaut just continues to roll on. Sonia, what about the broader market?
Okay, looking very good. The mid-cap index is up 200 points already. The market breadth is very strong, 9:1 in favor of the advances. By the way, almost 6% equity has changed hands on Syngene, as we were telling you earlier, and that stock is in focus right now. Apollo Tyres is the other one. Big moves coming in there post the Morgan Stanley brokerage report. So 3.5% higher on Apollo Tyres, and now it's actually very close to its 52-week high. The 52-week high is about 268. Apollo Tyres at 264, so virtually there. Then you have a couple of these other names: Bandhan Bank, Zomato, Manappuram Finance, all looking pretty good this morning. In fact, banks in general, all the PSUs, Bank of Baroda, Punjab National Bank, are all moving up. Dish TV is up almost about 9-odd%. Suzlon continues its upward move, so keep that on your radar as well. And a couple of other names. On the downside, though, few and far between, really. Exide coming in for a bit of profit taking after yesterday's big run. Tata Tele Maharashtra down about 1.5%. GAIL, okay, not GAIL actually, GVK Power is what I'm talking about, 4.5% lower on that. So do keep an eye out. By the way, Paytm, let's take a look at that. It came out with its business update for the month of August. The number of loans disbursed have gone up substantially, almost 250% year on year and 100% month on month. And the value of loans disbursed has also gone up. I think that's what the street likes. It's now up almost about 2-odd%. So good opening for the market.
Oh, fantastic, right? So the move continues, and little or to no heed to what's happening globally. The Nifty is up 75 points now. So that gap between what the rest of the world is doing and what the market here is doing is widening. And how? 17,738. So this is super, super strong by any yardstick. Manish Chaudhary is our market master today. He's the Asian equity strategist, equity cash for Asia Pacific at BNP Paribas. He's joining us to take some questions. Manish, great to have you with us here. Thank you very much. So the question is about this outperformance. I put out a piece on Friday, and we played this up yesterday as well, about how maybe there is increasing clamor to unbundle India from the emerging market pack. Emerging market funds is the route through which foreign funds come to India. And with bulk of the emerging market constituents facing pain of one sort or the other, big and small, flows get impacted. Prospects here are looking better than most other emerging markets, so that case of unbundling is being made. I don't know if that is already playing out. What do you make of this very stark outperformance that we have on our hands now?
If I look at Asian emerging markets, it's really India and ASEAN which have outperformed significantly this year. In fact, on a dollar-adjusted basis, India is just about negative. It's kind of almost teetering on the edge, one could say. And there are some other, ASEAN markets like Indonesia or Singapore, which have actually given positive returns this year. There's a reason behind this. Number one, if I look at the large North Asian markets and China, they've been affected negatively. The sentiments and earnings estimates have been affected by various different reasons. So first of all, there's a concern about sharp economic slowdown and a recession in the developed markets. Therefore, Korea and Taiwan, which cater to those markets, the large exporters are geared to those markets. They have not only faced significant earnings estimate decline, but also significant underperformance as far as stock prices are concerned. In case of China, even though it has a large domestic market presence, the zero COVID policy has actually dented economic growth and consumer demand growth very strongly. And we have also had some of the exporters, particularly the tech exporters, not doing so well because of the same reasons for Korea and Taiwan. So the kind of fund exodus that we have seen from these North Asian markets, part of that has flown into the South Asian and India, and the Indian market. On top of that, some of these markets have also fundamentally done better. I mean, we have seen India move back very strongly as far as economic growth is concerned post-COVID. We have seen earnings estimates of some of the core sectors like financials, some of the private sector banks, they have moved up of late. Some of the core economic variables that we talk about, like the loan growth in the banking sector, they have revived quite strongly. So I think it's a combination of many things. I mean, there are quite a few of the large North Asian markets which have become relatively unattractive over the past 6 to 9 months. Some of the ASEAN and the Indian market, they have become relatively attractive, partly because of their commodity exporting nature and partly because of the domestic upturn in the macroeconomic variables that we have seen in these markets.
Okay. Manishi, hi. Good morning. So, from the point of view of earnings and from the point of view of valuations, the Indian market is now trading at almost record premium to emerging market peers, right? Do you think
Yes.
will that make you a bit nervous, or do you think it's a market where momentum can do crazy things?
Right. It's a difficult question to answer, but honestly, the kind of premium that we're seeing right now, as far as Indian valuations compared to emerging market or the Asian peers are concerned, that is a bit concerning over the short term. So it may happen that the Indian market could take a breather. We could see some kind of a time correction in the near term where the market stays flat and therefore the valuations decline, not because the market declines, but purely because the earnings estimate progressively increases. So, I think in the short term, the valuations are looking a bit stretched, especially when compared to the rest of Asia. But as I said, I mean, market loves growth. Equities are geared, equity investors, they love growth, and wherever they can see earnings growth, wherever they can see earnings estimates being revised upwards, those are the markets that they will flock to. So, over the longer term, we are still not budging from our, overweight stance on India.
Okay, by the way, there are plenty of stocks that are hitting fresh 52-week highs, and we should point them out. BEL, this whole defense theme has played out beautifully. So BEL is up at a fresh high. Ashok Leyland is sitting at a fresh 52-week high. M&M Financial, you have something like a TVS Motor. ITD Cementation. Oberoi Realty is at a fresh 52-week high as well this morning. That stock is now up about 22% for the year. Manishi, hi, good morning. I wanted your thoughts on this entire consumption space, whether it's autos, real estate, consumer durables, FMCG. Domestic consumption has picked up in a big way. What stands out for you, where there is growth potential and also valuation comfort?
I think growth potential is clear, because it's kind of bouncing back from the kind of COVID lows that, that we've seen over the past 2 years or so. So over the next couple of years, at least, for both staples and discretionaries, and particularly for the discretionaries, we're likely to see, the kind of growth recovery that we're seeing now. And I would also point out that late last year, second half of last year and the first quarter of this year, there was severe concern on the margins of these companies, consumer staples and discretionaries, because of the commodity spike. But now we're seeing industrial metal prices, soft commodity prices, they have declined quite a bit. So I think that margin concern that we have seen earlier over the past 9 months, that is kind of being turned on it.
Oops, there's some issue with your video, Manishi, so we'll come back to you in a bit. For now, just want to point out that the market is doing quite well, actually, about 0.5% higher on the Sensex and the Nifty. The Bank Nifty is not outperforming today, but it's still up about 130 odd points. These NBFCs are doing quite well. M&M Financial has been at the top of the pile, for a while now. So that one is at a fresh 52-week high. Manishi, sorry, we lost you there for a second. You were telling us about the outperformance that India has seen?
Yes, I mean, I was specifically focusing on the consumer stocks, both staples and discretionaries, and I was talking about their margin estimates. Because earlier, I mean, till, let's say, the first quarter of this year, there was a huge concern on margin estimates because of the commodity spike. But now those commodity prices, industrial metals and soft commodities, they've declined quite a bit. So margin estimates are being revised upwards, and that's leading to earnings estimates for these sectors being revised up as well.
Okay. Manishi, we've seen quite a bit of run in some of these tier 2 banks. Any thoughts here? What could be leading to this move?
Well, I mean, obviously, it's the more optimistic outlook on loan growth. Loan growth, which was just about 6 to 7% last year, has now moved up to about 14%. And, therefore, there is clear sort of consensus emerging that both consumption loans and corporate loans, both these engines are beginning to work together simultaneously. So I think that's sort of driving this outperformance on the part of financials. That said, we are not really kind of venturing into those tier 2 or tier 3 banks. Our focus is still on the large frontline private sector banks, which we think would be the gainers, not just from loan growth environment improving, but also which obviously would lead to higher net interest margin expansion for them.
Okay. Well, I wanted to talk a little bit about some of the other emerging sectors, right? There is the defense space, which has been rising quite a bit. There is this new energy space, which is picking up. I mean, Reliance just made another small acquisition of a solar energy technology company. So there's lots happening here as well. How are these spaces for you as an investor in the long term?
See, obviously, there are certain sectors. You mentioned defense. I would possibly add new energy, including the entire electric vehicle supply chain, both the OEMs and the battery and the materials sectors below them. Also, solar and wind power. These are the sectors of the future. So over the longer term, we will obviously find more investment opportunities in these sectors. As of now in India, much of this is sort of in the private equity space. They're not listed. In a sense, India is possibly 10 to 15 years behind China, but in the Chinese onshore market, you can find a whole host of listed stocks in these areas. So yes, I mean, these are no doubt attractive spaces. There would be more interest and more investments from secondary market as well at some point of time. But at the same time, one has to be, sort of vigilant about the valuations that, one pays about in these sectors. And at the same time, there has to be a careful identification of the winners, because like we have seen in many sectors, there's a deluge of entrants at the beginning. Not too many of them survive at the end. So it's a difficult selection process that the investors would have to go through.
Okay, Manishi, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. Well, the market for the first time might be showing that at least there's some profit booking at higher levels. So just keep that at the back of your mind. 17,722 on a Nifty. The market's been very strong. Make no mistake about that. And the broader market still remains quite strong. 4:1 on advanced decline. A lot of laggards are now sort of making their moves. Apollo Tyres, for example, Manappuram, Jubilant Foodworks, First Source. These are all laggards. These are all moving up now. You could throw in a couple of other names. BHEL is moving higher. And of course, there are some stocks which are in a bull market of their own. Defense stocks, for example, Hindustan Aeronautics. What a move it's been on HAL and BEL as well. Just relentless. BEL last month when it came out with numbers was somewhere around 240, 250. The numbers look good, but after that, it's just not looked back. 332 today right now. So, clearly there is huge amount of momentum in the broader market right now, Sonia.
Absolutely. And just look at these names, right? Apollo Tyres on the back of the Morgan Stanley report is up almost 3.5%. Paytm on the back of the business update that has come through in August, which is looking quite good. Paytm is up almost 1.5%. So any positive news flow, any hint of positive news flow is really taking these stocks higher. And of course, it's the return of the laggards as well. Many of these stocks have been beaten down for a while. But let's do one thing. M&M Finance posted its business update for the month of August. It indicates a 75% year-on-year growth in disbursements, while the year-to-date, the growth has doubled. This strong disbursal growth, however, has not translated into AUM growth, and the company's write-offs have also remained elevated over the last few quarters. Ramesh Iyer, the Vice Chairman and Managing Director at Mahindra Mahindra Financial Services, joins us now. Mr. Iyer, that's the first question. Despite strong disbursals over the last few quarters, your write-offs continue to remain quite elevated. Why is that?
I don't know what's the correlation you're trying to draw, but the disbursements have been good, collections have been good. Write-off is an outcome of our NPAs that we settle with the customer, either take back the vehicle and settle, or offer a settlement to the customer, and therefore the balance gets written off. So it is from the past NPAs which have been fully provided for, we take a call to write-off. So it will have a contra from the provision coming down and moving towards write-off. Whereas the disbursals are a direct relation of the sentiments of the market, how we see the market progressing from where it is, what's the demand for vehicle, tractors, pre-owned vehicle, and all of that. And we've been beneficiary of that as we see the sentiments is very, very positive in rural.
Okay, I think the question arises as to, why the asset quality perhaps continues to deteriorate, right? On a quarter-on-quarter basis as well, you're sitting on, 8% gross NPAs compared to about 7.6% earlier. So just trying to understand whether, despite an overall growth, are you facing some pressure as far as asset quality is concerned?
So not at all, right? I mean, this we have talked about it several times in the past. Rural, the first half is always very different from the second half. So when you see a March ending at 7.77, and that's kind of remained almost at the same level as we speak, we expect that the next 2 quarters should only show much better improvement to this, because the cash flows in rural substantially improve in the second half. The harvest money starts to come, the tourism at its best, the people movement goes up. So all of this money starts to come, and this is not for this quarter or what I'm talking, it's historically been that way. And therefore we see definitely the benefit of that in the second quarter. And you look at the collection efficiencies have remained at 96% even in August, in spite of many places, monsoons, not full activity levels. So this is typically of the first 2 quarters. Also important to see the stage 2 coming down, which means the forward flow is not happening. Put this all together and you will kind of, read the conclusion that the asset quality is actually improving month on month, and we would see this substantially change in the next 2 quarters as well.
Okay, Mr. Iyer, good morning. What's the guidance for credit costs for Q2 and Q3?
So we've always said that, we expect as we move forward to close it around 6.5 as the gross NPA levels. And we are carrying a very high coverage ratio, close to about 58%. And that would mean that our net NPAs would be sub 3%.
Okay, net NPA will be sub 3%. A guidance on return on equity, Mr. Iyer, when can it touch 15%?
Actually, our capital levels are very high. If you look at our capital adequacy, we're at 24-25% kind of a number, and we've just started growth in our disbursement and asset book. And you look at our 3-year horizon, we have said that it will go to 12%, then to go to 15% in the next 2 years.
You lend to a lot of sectors, tractors, cars, utility vehicles, CVs, and there are diverse trends that we are seeing across the board, right? I mean, cars are picking up in a big way. Tractors were slow up until the last couple of months. Now, finally, there's some growth that's come back. Can you tell us what is the situation on the ground? Where do you see the pockets that still need to recover, and where is the maximum traction now?
I think you're right. Tractors did go slow in the first 2 months, and then we started picking up again, which is direct indication possibly of the contracting segment now buying tractors, and that would actually accelerate the growth there. As far as cars are concerned, availability continues to be some kind of an issue, and we do see once the vehicles are going to be more available, the festival season should end up extremely well. The pre-owned vehicle segment is very buoyant, and since the new vehicle non-availability, the exchange is not happening so much, and therefore even they are facing the supply side issue. As the supply on the vehicle, second-hand vehicle or the pre-owned vehicle starts becoming available, I think even that market would show even better growth. So I'm not able to see any segment which is going through any pressure. Even commercial vehicles have picked up. Neither are we seeing this pressure in any geography. And which is why we continue to say that the next couple of years should see this growth momentum being maintained in the rural market.
Fair enough. My question on credit cost also was a bit related to the fact that you'll be changing to the NPA norms, new NPA norms from 1st October. So how do you see that in context of that and the asset quality?
Yeah, so I don't think we see any major pressure. As I said, we are carrying a 68% coverage, and that's only a reporting norm, IRAC norm. So far as the accounting is concerned, will continue to be under Ind AS, and we may not be required to make any additional provision the way we see our collections and NPA corrections happening.
Right. Mr. Iyer, hi, good morning. We've been speaking with companies in, say, for example, the consumer durable, you do consumer durable financing, etc. as well. And, the feedback was, for example, we spoke with Godrej Appliances just last week. They said sales in rural areas are down at the lower end of the segment, but that's primarily in rural areas, is down 20 to 25% compared to same period last year. Premium is doing extremely well. Are you seeing some of that too?
We are a very insignificant player at this stage in consumer durables. We just about started. We don't even do 2-3 crores, and we are yet not gone into rural for consumer durables. So we are also just in 4 or 5 states and districts. And I don't think our numbers will really guide the market sentiment. What we see in rural market, at least for the segment that we are in, the cash flows are holding up both in terms of people able to bring margin money to buy new vehicle and in our own collection. So I'm not seeing the similar pressure that you just expressed from a consumer durable side, but that's not the pressure we see on the vehicle front.
Okay. Fair enough. That's interesting. But could this be a signal of any for sort of future stress, or you think it's unlikely?
See, clearly, if somebody is able to bring 25% margin money, which means the cash flows are holding up. And where is this cash flow coming from? If you look at people movement, tourism, schools have started, contracting segment is doing well. So these were the cash flows which were hurt, around the COVID time. And we talked about it when we had a very high pressure first quarter last year. And then we said that these are the segments which are going through pressure. And as they kind of start to improve, we'll see improvement there. And today we see improvement in all of this segment and with no exception to geography. And which is why I'm not able to kind of, believe that there is a pressure out there. People are earning well and therefore they are repaying as well.
I just had one more follow-up on the trend that you're noticing right now, because within the commercial vehicle space, what we saw in the month of August is that the growth rate has slowed down quite a bit. It's now single-digit growth that, a lot of these players are looking at, whether it's Tata Motors, M&M, about 6-8% growth. Of course, the base effect is also off, but just wanted to understand that has there been any slowdown in terms of movement of commercial vehicles compared to what it was? There was pent-up demand about 6 months ago, but now what is the, the average that we're looking at?
I think the way one has to look at it, I think the less than 5 truck owners are still not coming back to buy. And therefore, it's not adding up to growth. The fleet operators bought enough, and therefore the growth was double digit. And now that they have added sufficient capacity, they are probably not adding too many. Until such time, we don't see first-time buyer, single truck owner, less than 5 truck owner come back. You would continue to see this growth remaining in the single digit. And once they start coming in, and they would normally come in only when the market completely opens up and they're able to price for their cost completely. You should also understand currently the fuel price is high, whereas the freight rates have not gone up as much. And therefore, someone at that level of less than 5 truck owner to now invest may probably wait and then come back. And that's causing little pressure, I guess, in the overall volume growth.
All right, Mr. Iyer, we'll leave it there today. Thanks a lot for joining us. Good talking to you, as always. Before we take a break, just a word on the market. The bank Nifty slipped in the red, and the Nifty's gains are down to just about 8 points. I mean, just discussing 10 minutes back, that may be the first sign of just a bit of profit taking, not fatigue yet, just signs of profit taking, because we've had a one-way move. And whenever it's led by the market-leading sector, you need to tend to give it a bit of an importance, and that's what was happening with the bank Nifty. So now, you're actually at the low point of the morning. We'll take a break. Up next, we'll get chatting with Snehal Shah of Century Textiles, the management that hasn't spoken to media for long. So we'll get their outlook going forward. Later, we'll connect with Chandru Kalro of TTK Prestige to talk about the demand outlook.